future of fixed income, unleashing tokenized assets in the capital markets. I am Kelly Matheson. I'm the Chief Business Development Officer here at Digital Asset, and I am delighted to have with me today two industry colleagues who will provide some incredible insight and perspective. First, who you see on screen is Monica Somerville. She is the head of the capital markets practice at Celent. And second is Richard Frenner, who is the Director of Public Policy at Euroclear UK and International. Richard is having a couple of challenges with his connection, so you don't see him yet, but you will at least hear his voice momentarily and hopefully see him on screen. But we will get him on the call to join. So just let me give a little bit of foundational comments and some housekeeping. Actually, I'll do the housekeeping first. So our webinar today is being recorded, and it will be available on demand shortly after it wraps up for any of you who might want to view it again or share it with some colleagues. We will have approximately 45 minutes of discussion, followed by up to 15 minutes or so for Q&A, which means we actually welcome questions throughout the discussion. Please feel encouraged to submit any questions that you have as you have them as we go along in the discussion. You could do that by just entering the question through the question mark icon that's available in this tool, and we'll endeavor to answer them as part of our discussion or just hold them for the end. But we really look forward to having some interactive dialogue with you. So to set the stage for today's discussion, momentum is building around the tokenization of real-world assets for use in capital markets and across financial services activities, with recent developments signaling a significant shift towards more accessible and efficient financial systems. As one core example of this, and we'll spend a little bit of time on this today, the 56 trillion or so universe of marketable securities holds immense untapped potential for use across securities financing, liquidity, and collateral management activities. Yet only a fraction of that, about 11%, is currently accessible for use as collateral. Now, this is largely due to settlement system and market cutoff time limitations. The assets are just not easily or practically accessible for use across the markets and time zones. So activating even just a sliver of these trapped assets could revolutionize the settlement and securities financing activities. It could reduce risk, enhance liquidity, and unlock incremental yield opportunities for the asset owners. However, the rise of token islands, for lack of a better description, and fragmented ledger solutions threatens to stall this progress, creating new barriers for liquidity and market efficiency, even beyond those that we have already. Adding complexity to this, the progress remains a bit uneven across regions and jurisdictions, with advanced markets experimenting with tokenization and the use of these assets, while others, frankly, lag behind. Building global solutions requires balancing both the innovation with legacy systems, a real practical way of getting at creating new securities and payments rails while integrating them with the infrastructure that is already in place and will be for a reasonable period of time. Monica, if we could turn to you first, with that as the foundation. Celent has done some incredibly insightful research that can help set focus and the direction of let's say the direction of innovation travel, for lack of a better description. Could you provide an overview of the market themes and the research? And I think you have some information we're going to share on screen as well.
Yeah, there should be a slide with some data, and this is really picking up on the the theme of momentum. So if we forward the slides,
there we go. Yeah,
that's the one. Yeah, so I'll explain this chart in a minute, but it's really it's focusing on that momentum theme that that Kelly, you were just talking about. And this is data from a recent survey of financial institutions that Celent has conducted. This is our annual Dimensions survey, and in that survey we ask about technology priorities, strategies, budget, trends across, and this is across the buy and the sell side in the capital market space. So this year we had over 200 respondents across the globe. And the survey was conducted in the first quarter of the year. We'll be doing it again early next year. So as part of the survey, we asked loads of different questions, but we asked two questions in particular that I think are relevant here. We asked respondents to sort of select the top 3 technologies they think have the biggest impact on the industry in the coming 5 years. And we also asked them about the overall adoption plans at their firm across a whole range of technologies. So it's on a scale from 0 to 5, with 0 sort of being doing nothing and 5 through to kind of at scale in production implementation. So we've plotted those answers here. And we've got the impact along the x-axis and the average implementation. So we've averaged those scores on the y-axis. As you can see, and this is the buy and the sell side combined, so that's the over 200 number. And as you can see, DeFi and tokenization placed in the highest in terms, so it's on the upper right hand side there, placed in the highest in terms of impact, and also ranks among the highest in terms of adoption status, with the average score indicating that this is largely in an experimentation phase at their firm. And I think that really aligns with what we've been seeing this year in the industry. There's a lot of experimentation going on and just the early signs of that kind of production work. We did have some of the respondents saying they're in that phase. Blockchain in general, so blockchain GLT, so that more general infrastructure, and CBDCs in particular, as you can see on the chart here, also score very highly in terms of both impact and adoption. We've run this survey before, so in terms of momentum, this is a static look at last year, but we can share with you that both DeFi and blockchain were among the technologies that we're seeing some of the strongest momentum in terms of the impact ratings. So on the sell side, for example, when we look at this data from last year to this year, the only technology that had a biggest increase in expected impact on the year-to-year basis was artificial intelligence. I think that probably won't surprise anyone with all the impact and interest in Gen AI this year. But blockchain had the second biggest increase, followed by DeFi. And on the buy side, we also saw momentum increasing in terms of what people thought was the impact of blockchain and DeFi. And in that case, DeFi had a stronger momentum, which again, I think aligns with what we're seeing in the market and hopefully what we'll be talking about a little bit later in this conversation. So there's just some background, hopefully, to set our conversation up.
Yeah, no, that's fantastic. Thank you, actually. It's nice to kind of sort of see it laying out, organized, and I think it really does point to giving a real indication of where there is momentum. And what I'll probably just add on is what we're seeing is indeed that one of the points that you have on there, the momentum for collateral mobility, has reached a critical point. So this is kind of me asking and answering a question of myself on the panel, but we're seeing that as a critical point, and we can come off the screen and advance it forward. A critical point driven by evolving regulatory, market, and technical factors that you have here. Just to add on to it, at Digital Asset, we're working with clients to build the Canton Global Collateral Network, targeting 5 primary areas of market transformation, many of which I think kind of spring forth from the slide that you just shared. Just to run through them and give our perspective, first, what we're seeing is a focus on improving liquidity and collateral management or collateral use. Regulatory changes like Basel III's liquidity coverage ratio and the net stable funding ratio, and initiatives to enhance market stability, such as the U.S.'s new rule to centrally clear all eligible secondary market U.S. Treasuries that's starting next year, all highlight, I think, the urgency of more efficient global collateral systems. Seamless services are becoming a competitive necessity in this sense. And what this means is that we're seeing an unlocking of assets to meet rising collateral demand. I mentioned in the intro, with only about 10 or 11% or so, about 28 trillion of marketable securities being mobilized as collateral today, there's a vast untapped potential. A network solution like some of the ones that you've pointed out on screen can unlock these assets without requiring risky or impractical market settlement transfers. What we're also seeing is a focus on addressing fragmentation and inefficiencies, which is a little bit of motherhood and apple pie to anybody in capital markets. But collateral in particular is often siloed in suboptimal locations, increasing costs and reducing the performance of those assets to be onwardly used to meet margin obligations or as liquidity. There was a really good paper recently done by BNY and Euroclear that noted assets, and I'm going to quote this because I just thought it was really specific and purposeful. Assets are often held in custody at a location other than where they can be utilized as collateral most optimally, introducing drag on performance and increasing funding costs and other expenses for market participants throughout the value chain. What this translates into is another area of focus that we're seeing, enabling greater capital efficiency through access to real-time data to be able to make decisions on how to move that capital around or minimize its use. And the absence of immediate visibility into asset inventories in the various locations around the globe limits their optimal use for really anything, but in particular as a collateral allocation. So advanced data infrastructure can solve this, reducing capital costs and improving balance sheet management. And that's some of the activity that we get the great opportunity to focus on. And then finally, I think that this all sort of adds up to overcoming the limits of traditional processes. Now, this isn't to say that there isn't going to be the need for integration, a practical integration between legacy and existing infrastructure and this new and emerging infrastructure. But when you think about some of the processes and policies around them, such as divergent settlement times and market cutoffs, reliance on manual processes and systems, all of this begins to restrict the ability to use assets efficiently around the globe, in this case as collateral mobility, across geographies and time zones. And that just frankly adds up not only to the lack of access that I've talked about, but unnecessary risk and costs. So in short, we're focused on this as part of a global collateral network initiative to enable a seamless and efficient exchange of collateral across borders and time zones, fostering market stability and liquidity while reducing operational risks. I said it's a little bit of motherhood and apple pie. It's not something that the market hasn't wanted and demanded for years, if not decades, but it's now that you can marry that strategy with a practical way of implementing it technologically and operationally. And that vision not only aligns with industry needs, but also with evolving regulatory frameworks, making it quite timely and transformative right now. Richard, I think we have you on at least by voice and that you can hear me. Perhaps you could build on this a little bit. Pursuing these opportunities will require collaboration across the industry. Could you provide a bit of an overview of the public-private partnership, how our industry and supervisory authorities working together to mature or even just confirm the legal framework and drive adoption?
Thank you very much. And, a certain irony that these questions about interoperability mean that I'm struggling to get video for you guys, but I'm very happy to be invited and join in this conversation. Bringing the Euroclear perspective to some of these questions that you've raised, I would start by commenting as we have explored distributed ledger and indeed, other new technologies as a financial market infrastructure, our focus is really understanding where our participant demand is, first of all, and second of all, ensuring that what we do brings resilience, first and foremost, to the system. So Euroclear has embarked on a digitization journey, our DFMI platform. And the first module in this has been our digital securities issuance platform. So with that, we've been successful with a number of large-scale production grade issuances. We recently completed a program for the Asian Infrastructure Investment Bank that was a total of $500 million issuance. And what we saw there was a really welcome development with the Bank of England accepting that as eligible collateral. So as we developed our EFMI platform, some of those kind of qualities in terms of what liquidity the instrument is going to have, is it considered eligible collateral, or issuers, or they're going to get the credit rating that is appropriate. Those are at the front of our mind. Moving on specifically to this question about public and private partnerships, I really think that this sort of ecosystem shift that moving on to different sorts of technological rails really requires that close public-private partnership. And indeed, what we've seen of these catalyzing landmark issuances is that they are coming from supranational authorities or sovereigns. Focusing on the UK in particular, there's been a discussion for some time about the prospect for a digital sovereign issuance, and indeed we heard the Chancellor make an announcement along those lines in the Mansion House speech last month. So this is HM Treasury taking a proactive stance to a digital gilt, a pilot digital gilt, and they've chosen to do this in their digital security sandbox. And so, that for them is an opportunity to capitalize happening in the UK, observing how DLT can be deployed at scale, and ensuring that the legal and regulatory framework is fit for purpose, all the while observing, within a sandbox environment, how the market structure, ends up resulting in an efficient and risk managed environment. And so those are some of the things that we're thinking about for Euroclear in the UK, and how we can partner with debt management offices, authorities, finance ministries, central banks, to, in a responsible and resilient way, move forward on this digitization journey. So I'll leave it there for the moment.
That's great. Thank you. Actually, really, I think, interesting to hear the progression of regulatory focus with the major market infrastructure such as yourself that would be driving or executing the activities around it. I want to go into that a little bit, but before I do that, actually, Richard, there is a question. I think that it's really more a question to ask if it's something that you would be willing to follow up on with the person who raised it, but they're asking a question because I think it might not be something that we could get deeply into right now, but it's from Michael Berry of Candeal, who's asking, with regard to the digital asset securities control principles, that framework that was done recently by DTCC, Clearstream, and yourselves. A two-part question that he had, that analysis did not include in its scope secondary trading or stablecoins and CBDCs. And was there a logic or a rationale for that, or was it really just more a practical, not biting off more than you can chew in doing that analysis? And then he was also asking that of the operational saving estimates that were provided in that analyses of about 15 to 20 billion, is that a per year annual savings? And then had some onward questions about it. Is that something that you'd be able to comment on now, or should we take that away as a follow-up?
That's one that would be better that I refer folks to the authors of that report. Sure. Specifically, what I can say on a more general basis to this question of secondary markets is, what we have sought to do is take a kind of stepwise approach. So with that digital digital securities issuance platform at Euroclear specifically, that is one that issues digitally native notes, and secondary activity takes place in the legacy environment. And the driver of that is the essential issuer driver around those qualities that I described in terms of need for liquidity, concomitant requirements around the credit rating, and ultimately the cost of funding. Having said that, and as Kelly highlighted earlier, we're interested in these questions around secondary markets, whether that's buy-sell repo transactions in a sort of collateral management system. How might those processes benefit from technology deployment, and specifically indeed tokenization and DLT, and what you saw in that recent white paper, the experiment conducted with the World Gold Council with digital asset, was a enhanced mobility of collateral and a system with tokenized gold, tokenized euro bonds. And so that sort of experimentation found to be quite promising, and certainly we do hear from market participants about pain points and lack of automation within some of the secondary markets and the collateral management systems that pertain. I think in particular bringing in assets like gold into that collateral management environment and a tokenized basis is really fascinating prospect. So the bottom line on this, and indeed on the control principles, I can refer you to some of my colleagues, but the bottom line for me is looking at tokenization, distributed ledger, and indeed other technologies is a very exciting and kind of fertile area within that kind of collateral management discussion. And we're eager to play our part in an ecosystem shift, whilst acknowledging that ecosystem shifts are not easy. There's a lot of investment that is required. It needs to be done in a way that maintains the confidence of not only asset owners but also supervisors and authorities. So really the approach that we're taking is to ensure each step of the way we're building confidence within the system, and proving what can be a at scale adoption with the levels of resilience that you would expect from financial market infrastructure.
That's great. Actually, it's a perfect segue. I was going to say, now that we've each sort of given a little bit of the foundational perspective, let's turn to some lessons learned from the past. And I was going to say that crises are always good sources, crises that have unintended or unplanned ecosystem shifts, as you've said, Richard, are always good sources of guidance as new market models, operations, and systems are being created. So let's talk a little bit about what are some key or critical lessons learned to keep in mind as we go through and instigate some of those ecosystem shifts that we've just been focused on or just commenting about. Monica, would you go first?
Oh, sure. Yeah, happy to. And it's such an interesting discussion so far. But yeah, I think this is it's a good segue to look at these crises. I think, the obvious one to go back to is the 2008 financial crash. That crisis provided a real boost to regulators pushing for increased transparency, and it also had a huge impact on the capital requirements that banks. So both of those we're seeing kind of ramifications today, and their implications for blockchain technology. So if you think about the new regulatory reporting requirements around trade and transaction reporting in particular from Dodd-Frank and MiFID, overall push to clearing that we've seen as well and continue to see across different asset classes. There's really a clear endorsement of this idea that the way to create level playing fields is to remove or diminish that element of sort of information asymmetry that capital markets is famous for. Now, plenty of people argue, especially in the institutional markets, that too much transparency too soon, will have negative effects. But I think for the most part, regulators have gotten their way in improving transparency, especially. So I think some of the qualities of blockchain here really play well into that space. It's obviously accessible, the information there. It can make data extraction easier. So there's lots of interesting things that parallel with the technology there. On the capital requirements front, of course, I think this is a big tie-in with the collateral management that we're hearing about. There's a lot of interest here in mobilizing those assets. Firms do have to keep a certain amount of capital. It has to be certain types of capital, this high quality liquid assets. Not all these assets are accessible for collateral. I think, Kelly, you mentioned something like 11%, quoting that BNY study, of certain assets are available for collateral. So it's an area that, again, that we can see roots back into that crisis when, all the capital requirements were increased. Looking at this also from a DLT and tech angle, I think we could also talk about the FTX fraud. It had some useful learnings for the wider industry. People do talk about blockchain technology being immature, or they have concerns about the risks, new risks that technology might bring. But I think when we look at something like the FTX fraud, we should remember that really technology wasn't the main issue in this case. I think, if anything, the FTX collapse demonstrated the importance of really basic things like good due diligence. And that while clear regulation is useful and people are pushing for more clarity especially in the blockchain, DLT, and tokenization space, regulation alone is just never going to be the frontline defense against fraud. And that's really what the FTX collapse came down to. It was more of fraud, really not a failure of technology. We should keep in mind that blockchain projects, when they are so-called hack, it's usually a hack to do with a component of the blockchain, something like the smart contract or an off-chain component, maybe someone stealing or compromising private keys. I do feel like the blockchain industry is learning its lessons here as well, though. So data from blockchain tracking firm Chainalysis, they do an annual sort of study of the blockchain every year, and they found that for the first time since DeFi's emergence as an important sector of the crypto economy, the yearly total stolen from DeFi products fell significantly for 2023, and the value of DeFi hacks declined by nearly 64% year on year, and the median loss per hack dropped as well. It was a lower percentage, but still, it's good to see it going down. So, of course, there are several reasons why those numbers might have dropped, but I like to think that it shows more awareness and proactiveness around defending against more obvious attack vectors with this technology. So I think the industry is learning lessons there as well.
Excellent points. Thank you very much. Richard, do you want to build on any of your prior points to add with regard to lessons learned?
Yeah, absolutely. And I think this is a fascinating question around financial crises when we see stresses in the system and consider what lessons learned are. And I can definitely see conceptually how some of the benefits of distributed ledger have bearing on questions of transparency, automation, things that are particularly helpful in times of stress. And the fact of the matter is, certain of these processes have not been at the kind of cutting edge for investment. And part of that is that question about the weight that goes with an ecosystem. If we even look at shares in the UK, there's still paper in the system. It was only just recently that retail investors were able to access the gilt market through digital means. I mean, when you think about the sort of stresses that a financial crisis brings, then more on the wholesale side, when there are elements of automation that are still yet to be achieved, you can see that there's important things to think about from a financial stability and resilience perspective. So I think that the lessons from 2008, from the LDI crisis, are ones that we need to continue to study and assimilate. You can see the attractiveness of programmability and smart contracts in some of the ways that more elegantly orchestrated collateral flows could support financial stability in times of stress. I think it's an area that still requires a lot of study, and I heard referred to there's also risks that come with different market structures, forms of technology, etc., and those need to be equally weighted as we consider what a future ecosystem might entail.
Yeah, I'm drawn by the notion that we're all going back to some of the recent market crises to look for those lessons learned, some of which had repeated patterns from prior market crises. So I want to make a couple of points, and I've lived through some of them, so I want to make a couple of points. But two things that I'll just do first. One, where we got some questions in for some of the stats that I had said and cited, and I want to just share those out with everyone. So when I read that quote that I attributed to BNY and to Euroclear, that's from a publication that they did together called Bridging the Collateral Divide in November of 2021, the 10th of November, 2021. So Bridging the Collateral Divide is what you'd want to look for if you want more information on that. And the stat that I and now others have been referring to of the marketable securities and the proportion of it that is actively used as collateral, that actually comes from the SIFMA Capital Markets Fact Book. I'm sure it's something that Monica's very familiar with, but that Capital Markets Fact Book is published every July. It's super handy, has a great wealth of information if you're interested in looking at it. And that number has actually been increasing. In the July of 2023, the top line number was not 255, 256, it was like 230, but the 10 or 11% has actually stayed relatively the same, which means that the challenge or the opportunity has been perpetuating for the better parts of years or decades. Just so that I can give my comments on the same, I'm going to try and kill a couple of birds with one stone, because we got a really good question in of what are some of the key challenges or barriers that need to be addressed in order to drive greater adoption and implementation of the collateral network initiative that was previously discussed. So what I'll just add to the excellent points by Monica and Richard is when creating new market models and systems, the past crises actually that they both mentioned, a couple of them stand out in my mind, the UK gilt crisis and 2008, of course, the financial crisis, both underscore the critical importance of liquidity, transparency, and risk management, and highlight how solutions like distributed ledger technology, blockchain technology, and the use of that in something like a global collateral mobility network can address the systemic vulnerabilities that both of my partners here in speaking talked about. But just to chew on each of those a little bit more, the UK gilt turmoil in the September of 2022 revealed, I think, the challenges of liquidity mismatches and the challenges of rapidly mobilizing collateral in a stressed market. Pension, I mean, there's a lot of analysis out here. I'm not suggesting that what I'm now about to say is the be-all and end-all of it, but just from my perspective, pension funds and other naturally long or primarily long investors were forced to sell assets at steep discounts in order to meet margin calls due to delayed access to being able to get control of collateral and the fragmented market infrastructure by which they had to move that collateral across. So they're getting called for margin, but in order to be able to meet that margin, they have to sell something to raise cash to meet that margin, which further depressed the prices down and caused this pro-cyclical downward spiral that ultimately the Bank of England stepped in to help ameliorate. A global collateral network would enable a few things: real-time visibility into the availability of assets for use as collateral and the mobility of those assets across custodians and geographies, intraday and real time, reducing the time lag in meeting obligations and mitigating that fire sale topic, I'll personally say almost entirely. This is familiar to me to some of the challenges in the 2008 financial crisis, which I had lived through in a prior role leading a clearing and collateral management business. The collapse of trust in counterparties and the opaque risk exposures led to a cascading set of failures, but central to that issue was a lack of a unified, transparent system to track and manage collateral and the collateral obligations effectively. Blockchain and so it was really just hard at the time to have a handle or an understanding on what you were going to be called for as an obligation, and whether or not meeting that obligation or the lack thereof was going to destabilize confidence in you as a market participant. And was that going to create a precipitous set of activities that just further destabilized you to the point of, in some cases, non-existence? So DLT or blockchain can offer that shared immutable ledger where transactions and asset ownership are visible to authorized parties, not to everyone, but to the parties who are obligated to know that as responsibilities or have access to it as an agent or custodial function, and enhancing that transparency and reducing the counterparty risk overall by making that information available intraday, real time, fully synchronized, and then further moving beyond that to say that a network solution for collateral would optimize the ability to identify, access, and allocate it real time. And all of that ultimately, I think, just bolsters market resilience, even frankly during times of stress. So in the end, I would say both crises and all of the good points that Monica and Richard said, they both underscore the need for infrastructure that facilitates, in the case of the use case that I've been chatting about this morning, the need for seamless collateral mobility, real-time data transparency, and frankly, robust risk management, which is, I think, at the heart of some of these points. A DLT or blockchain-based global collateral network, such as we're focused on with the Canton Network, addresses those needs directly, offering tools and preventing similar systemic shocks, and ensuring that markets can function smoothly, frankly, even in the time of crisis, which is probably the best measure of all. So those are just some of the points that I would add on to the excellent insights that have been shared. Maybe what we could do is, I'm just seeing some of the questions, we could switch gears a bit, and Richard, go back to you, and then to Monica. In terms of there's a question that's actually very tightly tied to one of the things that we were going to talk about this morning. In terms of the technological advances that are driving the lessons and changes that we just discussed, where or what are the most promising technological developments happening today? And I think the question is kind of focused on, there's a lot of POCs and different temporary use cases out there, but what are you seeing as some of the best ways that for real practical production use, say, beyond the evaluative POCs? Richard, do you want to chat first about that?
Yeah, happy to do that. And I'll go back to some things that I sort of alluded to before, and really taking a bird's eye view, where on the one hand, we are looking in the UK at dematerialization. We're also looking at 2+1, and of course, then we're also experimenting with distributed ledger technology. So you kind of see in that span sort of several decades worth of technologies that are, at this same time being kind of dealt with on an ecosystem level. So, from the, kind of first principles piece around if we are using electronic digital means rather than paper-based ones to transact in securities, how do we ensure that those sort of hygiene factors are being attended to? So part of this has to do with the replatforming of the CREST settlement system that exists in the UK, and that replatforming is being undertaken using an event-based architecture, and essentially this is along similar lines to RTGS in the UK, and so the system is being built using very well established technology while future proofing for the possibility to plug in DLT, all on the basis that this is a kind of modular system. Moving on to accelerated settlement, that's an area where we have seen the kind of necessary adoption of increased automation, and that is something that the U.S. has lived and is coming soon to the European markets, and I think that's another area where we're going to see focus of investment. Then finally, with the question of distributed ledger technology and tokenization, clearly these are exciting opportunities to explore how the financial system can be made more efficient and resilient. And when we're thinking in terms of technology, I'm particularly interested in where there are means to facilitate interoperability. The real challenge that we've seen in this area has been fragmentation and how we avoid the well-known challenges that come with vertical silos. So my focus is thinking about, when we look at some of the initiatives to move on from proof of concept, like the digital securities sandbox, for instance, what technologies need to underpin that in order to ensure we have wide distribution across the market based on interoperable infrastructure. So those are some of the kind of principles that I bring to the question of technology, which ultimately for us is an enabler to achieve the kind of core purpose, which is markets that are well connected, that are resilient, and of course are efficient as well.
Fantastic, thank you, Monica. I wanted to pose the same type of question to you, and I want to give you the chance to answer that. But we actually have quite a few questions that have come in, and I'm just looking at the time, and I want to make sure we get a chance to answer some of these questions. So I'll give you the option of commenting on anything you want, but I would like to pose one question to you because I think it ties back to some of the foundational comments you were saying. So one of the questions that's come in is, why is now the right time? Blockchain technology has been accessible for nearly 10 years to traditional players and legacy systems. So why should an institution embark on the journey of tokenization now instead of waiting for a major player to take the lead? Actually, Richard, you might want, as a major player, you might want to comment on that as well. But Monica, I was just thinking you might be able to give some insights from what you're seeing across the market.
Yeah, no, it's a great question, and it has been. This technology has been in the market for a long time, and we went from blockchain to sort of crypto and back to blockchain. And the answer is, depending on who you are as an institution, maybe you do wait, right? Like maybe not every institution is going to want to go and build their own blockchain or even host their own node. They might not want to change the systems they use today, and they're just looking for their providers to offer them a connection to that wider network. So I would say what's really changed is things like we have moved out of the experimentation phase. There has been a lot of work and energy gone into this, and a number of, just look at any of the large banks, they all have tokenization platforms, or they have some sort of blockchain platform, and many of these are in production. You're thinking JP Morgan, HSBC, Goldman Sachs, Societe Generale, BNP Paribas, UBS. They're all there with platforms. We have FMIs like Euroclear, right? They've got offerings in the market. We've got exchanges in the market. So there are real in production platforms. That's a big change. I think the awareness about the need to break down silos has really come to pass. The industry has always tried consortiums. They're not very good at it, but for some reason that seems to be working really well in the blockchain space. We're seeing cross-fertilization, we're seeing interoperability working on, early leaders like JP Morgan, they're opening up the use of their tokenized deposit coin, to third parties. I have to say congratulations are owed to digital asset too. What you're doing with the Canton network is really helping in this as well, creating this sort of interoperable network. I know you're involved with a number of banks that I mentioned as well. And, when you look at vendor solutions, like Broadridge has their DL repo, where, their transaction, last I checked, they were transactioning about, I think it's a trillion monthly, $1 trillion monthly.
Trillion and a half, but who's counting?
There we go, $1.5 trillion, it's growing. And I think they just moved, right, correct me if I'm wrong, but they just moved to the Daml Canton stack. So all of that means that we've really good in place. And I think anything with technology, and we saw that in the COVID times as well, how quickly everyone was able to migrate to work from home. And part of that was because all this underlying work that had been going on for years in order to move backends to the cloud. So there was this huge cloud journey, and a lot of people weren't aware of it. And then we had a real need to take advantage of that. And we had this leapfrog where everyone could suddenly do things from home they could never do before. I honestly believe a lot of that background work has been going on in the blockchain space. People have been quietly beavering away. Things like, the kind of things that Daml's been working on with Canton, those are really good examples of that kind of baseline work. The interoperability issue is still something that we need to look at, and that's interoperability between traditional financial networks and DeFi, as well as blockchain to blockchain interoperability. So those are slightly different, different things, slightly different ways to handle it. I think it's an example of an important question when you're thinking about secondary markets. So Richard mentioned that earlier. I absolutely agree that secondary market activity for tokenized assets, that's really important problem to solve. And it's interesting because, Richard, you kind of put a different spin on it. I always think of, like, we need a market where you can trade these tokens in the secondary market. But, some of what we talked about earlier means there's some nuances to that I haven't thought of before. But not all, as I said, not all financial market participants are going to want to change their platform. So that interoperability is also a way of thinking about what happens at the infrastructure level. Perhaps people don't even know they're on a blockchain network, but they are doing it. So that's the other way you can approach it. So there are different approaches I just wanted to touch on them because some of them use the very traditional technology, which is APIs, right? APIs are used extensively in the industry. They're very trusted technology. So in some cases, interoperability is just by leveraging APIs, off chain. I think Onera is an example of that. And I think Canton has a node on the Onera network. The other approach is really to the decentralized nature. So you're using things like cross-chain interoperability protocols, and they operate within a programmable token bridge framework. And that will integrate with various things like oracles, which bring in that outside data. And I think, Kelly, you mentioned this need to bring in outside data to create up-to-date information in blockchains. So oracles are a way to do that, and that also facilitates cross-chain interactions. So that's something to think about. And I guess other examples too, we've seen blockchain as a service offerings increase. There's a company I know here, Kaleido, that's involved with a number of the projects in the financial industry. And then even just more generally, cloud providers. Cloud is an enabler. It's increasingly adopted across the industry. A number of TradFi venues are moving to the cloud. Some markets are in the cloud. So you can also look at what they're doing with providing some of the blockchain infrastructure. So all in all, I think that's why it's a good time to really be doing something now and thinking about your strategy. Do you want to be hands-on with the technology, or do you just want to make sure that your solution providers are hands-on with the technology? But you should have that optionality. You really need to make sure that optionality is there for you to be able to access the tokenized network and tokenized assets going forward.
Yeah, very well said. Thank you for going through that. I think that's this is also a very practical answer too. I think what the time is just now simply because market adoption is starting to happen in real commercial ways, right? So
yeah, I said that.
yeah, no. I don't mean it that way. You said it much better. Richard, there is a question that's come in that it's a bit of a blend, but it does have a regulatory and a policy bent to it. So I'm gonna read the whole question just to be true to the person who was asking it, and perhaps you can provide your perspective on whichever components of the question you feel comfortable chatting about. Secondary trading and settlement in a digital environment with stablecoins and CBDC is a likely progression of DLT collateral management. How difficult are the next steps? What are the necessary components, such as regulators recognizing the liquidity value in digital assets?
Yeah, thanks for that. So, listening to that question, what I think about is the element of a transaction that involves cash, right? The cash leg. This is an important, crucial consideration when we're thinking about how we, ultimately look at an end-to-end system that is on chain. In the Euroclear Bank DFMI that involved tokenized commercial bank money. Euroclear is a investor along with a number of other financial institutions in Finality, which is some people describe as a synthetic central bank digital currency, and indeed, we see central banks across the world looking at the possibility of native, if you like, central bank digital currency, and then so I think the heart of that question is there are a number of different options, and when it comes to systemically important settlement activities, what are the comfort levels of authorities going to be with the different options you have out there? And it's been an interesting discussion in the market in the UK, and that kind of public-private discussion about what cash legs options look like in the digital security sandbox. And I think there's even the possibility that could evolve as the sandbox does. But I think the key question is, how do we ensure that the stability of the financial system is equal, if not greater, in a environment that utilizes DLT rails, and a crucial part of that clearly is going to be around central bank money.
That's great. Thank you. A couple other questions, and I know we still have a few minutes left, so I'm going to try and jam them in, and then give a moment for any last words. One of the questions is, how would a unified DLT network for collateral work with custodians and national CSDs to keep collateral movements in sync? Maybe you each have a comment to say on that, but one thing I'll say just as a way to start, is a really good publication that was put out by Augustine Carson's and others at the BIS about the concept of a unified ledger and a FinTernet concept, which we've heard the BIS talk about a lot. I think it's easy to devolve into having a conversation about whether it's one ledger or multiple ledgers that everyone around the world is going to use. I've been in the financial markets for excuse me, nearly 40 years, and I've yet to see there be a common system or a common solution or anywhere near the semblance of agreement on doing that. So I'm not sort of holding out hope that that happens. I think instead, what it means when we are in financial services and looking to have a network or a environment or an ecosystem whereby data can move more seamlessly, more transparently, in a more real-time manner, what you're looking for are systems that can promote the balance of having a sovereign or sort of total control over the use of an app or the management and monitoring of an app. If I am the creator of a solution, I want to be able to decide who gets to use it as a set of clients under what conditions. And by virtue of bringing on one client, it doesn't entitle them to know everything about all the other clients that I have. So that sovereignty of an app needs to still be able to be preserved in a network ecosystem. The ability for me to set the rules for, say, my market or my system and what is important to me for privacy, both because of how I run what I do, but also for how I respond to and answer to the regulatory and jurisdictional restrictions that I have, that has to be preserved. At the same time, you have to have an ability for data to be able to move in a fully reconciled, seamless, and real-time form. And that, to me, is what we're looking to create with these ecosystems that allow for these separate sovereign blockchain instances to be operating, but at the same time for data to be able to move back as the market participants want across them. So to me, when I think about collateral and the custodians and the national CSDs, they would necessarily each still need to preserve the agent role they have over the collateral assets and the ability to control and be the central securities for an asset. Nothing about that should change. But in tokenizing those assets, enabling them to move across a network, I can both get that best blend of having the control that I need, either because I'm hired to do it or because I'm regulatorily defined to do it, and at the same time make it so that that digital form of asset is now unbounded by settlement systems and cutoff times that were the prior way of preserving that control and privacy. So to me, that is what a unified ledger is what we're striving for in the solutions that I've talked about this morning, to be able to not rip away from a custodian or a CSD their ability to provide services on the real world asset, and to operate under contractual or regulatory controls, but at the same time make that asset express now in a digital form so that the data can move seamlessly across applications as I, as a collateral user or market participant, would want it to. I don't know if Monica, Richard, you want to add anything onto that, but I do want to leave some time for any last words. So maybe Monica, you would want to add on, or any last words as we wrap up the webinar. Yeah. I can't believe we actually have gone up to the actual end of the time.
We could just have a whole section on this. And I do think what you just said was excellent. And I do think custodians already manage a lot of connections. And I think one thing to think about when you connect networks is like, what is it you're trying to get across? Are you just trying to get the data and information across? There's legal issues around ownership. Is that transferred to the next network? So it's not always a technical question. And they're doing it now. Custodians, they sit in between a lot of different providers and they have to juggle some of these kind of questions. And the issue of real world and tokenized assets is going to be an issue for a while. So again, there's a need to provide a unified view across that. So there's a lot of ways that custodians still need to add value.
And Richard, thank you, Monica. It's just been wonderful having you here today and all of your thoughts. Richard, maybe some last words on your part, since you are both a custodian and a CSD.
Yeah, thank you. So, I think the first place to start is we need good international standards from public authorities, and then that FMI cooperation that indeed Euroclear has kicked off with DTCC and Clearstream. Ultimately, these private sector infrastructures are the ones responsive to market participants, so are going to help advance this. So yeah, another plug for that paper if you want to read more about our ideas in that space.
Great, thank you. Well, listen, we are bang on the top of the hour. Thank you to all of you who joined. Thank you for all the questions. If we didn't get to your questions, I've tried to write you back, and we will get time with you directly, or I'll help get you connected to Richard or Monica. If you have anything that comes up after this that you want to ask us, please just reach out. And thank you again to Monica and Richard for taking the time today.
Thank you.
Appreciate the invite.